Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Want to take a quick look at Apple. They just had a pretty good day after an upgrade or two. That was after some downgrades or two. That just sort of happens in the stock world. Stock is still down 4% in the last month, but go 1 year out, up 40%, go 5 years out, up 378%. And some people may downplay this 40% increase because the Nasdaq was up 50%. Some of the other big seven names were up hundreds of percent, so maybe 40% isn't all that amazing, but it's still a pretty damn good year. And I wanted to see what's going on with Apple, whether I still am comfortable holding so much of it, because if you saw my last video on my stock portfolio, you saw that I'm holding 34% of my individual stock portfolio in Apple, and that's been very good for me because I bought this stock in 2016 or somewhere thereabouts, so I've returned almost 600% on those shares. But I did sell some right before the year crested, and I'm considering selling a bit more because I don't know if holding so much of my portfolio in this one name that's done so well in the last 10 years is a good idea, because how likely is it that they're going to overperform the stock market again in the next 10-year period? Are they sort of a more mature company where the returns are going to slow down? If you go 10 years back, the S&P 500 is up something like 11% annually, but Apple is up 28% annually. That is a huge outperformance. Now, I've benefited from that by holding so much Apple, but am I really certain that that's going to be the case going forward? Or should I reduce my allocation to Apple, given the fact that I already have a good holding of that within my index funds, and also will still likely hold, 20 to 25% of Apple if I do sell a little bit, because I have been reducing some holdings, and Apple is a consideration for that reduction as well. Again, if you're not familiar with Apple, welcome to Earth. This is a company that makes the iPhone, if you're not familiar with it. They also make the Mac. They have a category for the iPad, their wearables, home and accessories segment, and then their services segment, which has been growing really well. And really one of the reasons the company has been repriced by the market. Services includes, all of the stuff in their app store, Apple Care, all of their entertainment services, Apple TV Plus, Apple Music, etc., all of that nonsense. And it's growing at a really good clip. Whereas some of the other parts of their businesses, and even the business as a whole, if you kind of look at the revenue going from 394 billion to 383 billion. Yes, that's billion in revenue a year, is shrinking, but the iPhone is shrinking a little bit. The Mac is shrinking quite a bit. The iPad is shrinking a little bit. The wearable segment is shrinking a little bit. Services is growing, but overall, the company in the last year at least shrunk. Still generating a ton of free cash flow. This is a company that generates $100 billion of free cash flow a year. So it's certainly earned the valuation it's given, but it is starting to slow. The growth that we've seen in the last couple of years might not be the case on a go forward basis. We'll talk about why that may or may not be the case, but really the bull thesis here would be that we're due for an iPhone upgrade super cycle, meaning a lot more people are going to buy the iPhone in the next couple of years and kind of give them that boost that they need, that growth that they need again, because the iPhones that are out there are about 4.5 years old are on average, and that's generally the highest they've been in quite some time. But again, the bear reflection to that would be maybe people aren't going to upgrade as much as they had in the past because phones are just not getting that much better with each iteration. The bull response to that would be, well, generative AI is a thing. And I think the next step in generative AI would be edge AI, meaning that the AI calculations, the AI computing is done on the device. And we're not quite there yet, but if you can get an iPhone that has AI capabilities built into it. Whereas right now, if you use OpenAI or whatever, it kind of goes out into the cloud. The calculations, the compute is done out there, comes back to you with the results. Obviously, there's some safety issues with that. You're not in charge of your own data. It's not on your phone. It's not on your computer. It's out there in the cloud. Whereas if you kind of move it to your computer or to your phone, it's safer. It's more private, etc. All of that nonsense. But probably a few years away from that. One of the knocks against Apple in the last year or so is that all of these other companies are talking up AI, doing stuff with AI, generative AI, etc., hardware for AI, etc. Apple hasn't really done that. Their mentions of AI on their phone, on their earnings calls, have been a fraction of all of the other companies. I mean, obviously, Apple is already doing stuff with AI, but it's small little things here and there that you might not notice. However, I think that Apple is in a good position to actually monetize AI when and if they decide to step into it in some way. They could create an app called iCreate or iGenerate or whatever they want to call it, IAI, and then add it to their services bundle, charge a couple of bucks for it a month to use the open AI type features that it might have, or the Adobe Firefly features that it might have. All of these things that could just kind of exist on your phone that a lot of people just aren't using in the consumer space right now. Certainly, some people are using OpenAI. Certainly, some people are doing stuff with that, kind of testing it out, using it in their jobs, using it in their day to day. But my parents aren't using it. My girlfriend's not using it. A lot of my friends aren't using it. But if that stuff comes to your phone, all of that computing power is within your phone with a chip upgrade. Should that drive a huge iPhone upgrade cycle? Of course. Could that be a boost to their services growth? Totally. And I think that's kind of the next step for Apple. But it might be a couple of years away because Apple kind of takes their time with a lot of this stuff. They're generally not the first to do something. They wait for it to be kind of baked, and then they step in with a product that's potentially best in class. And on top of that, Apple's doing AI the right way. They're sort of making deals with newspapers, etc., for the computing, for the training data that they need, whereas some of these other companies just kind of used it and now they're getting sued into oblivion because of that. Whether or not that leads to anything for those companies remains to be seen, but certainly making deals with the companies that house the data, that control the data that you need to train these AI models is probably the right way to go about it. Speaking of lawsuits, the bear thesis for Apple would be there's a bunch of lawsuits that they're dealing with, antitrust stuff that might come into play pretty soon. Don't know why that would be the case because Apple is kind of a closed warehouse, but I guess the fact that their App Store doesn't allow side loading, their App Store is kind of a closed warehouse that nobody else can compete in, is a problem for the government. So that might be some antitrust issues with that. Obviously, the iPhone is a walled garden, which some people like, but the government might like that because they want more competition in this space. Really, if you talk about OS in the phone space, operating systems in the phone space, it's kind of Android and Apple, and that's it. So Google's been in some antitrust issues, and obviously Apple is probably going to see the same thing. On top of that, there's some patent issues with their watch. They're removing some of the blood oxygen sensors because they really don't want to deal with that stuff, which is kind of an issue for them. Is that going to lead to some wearable issues as far as sales goes on that front? Speaking of wearables, the bull thesis would be, well, you've got the Apple Vision Pro coming out. I don't think that's going to be a huge revenue boost, at least in the short term. It's $3,500. They're only going to produce 500,000 units for 2024 at most. That's what, 1.5, $1.7 billion in revenue. When you're talking about a $400 billion a year revenue company, that doesn't even really turn the page. But if this is a new category that it's going to catch on, if they're sort of iterating on what MetaQuest is doing and making it better, and eventually making it cheaper so that the average consumer can actually buy it, could be something that's going to boost their company for years to come. It's just hard to tell right now, so it's kind of a maybe. And then you've got your services business. Again, generative AI could really boost that. You're growing that at a pretty decent clip. There's 2 billion devices out there, 2 billion Apple devices out there with 1.2 billion users. The more services you can sell to them, the more you can bundle that, the more high margin revenue you can get. And that's really where this business is heading, where it's more of a reoccurring revenue business on the services side versus a hardware business in the long run. Although certainly hardware is still driving their company's sales and a lot of their profits, but hardware probably has a limited growth path outside of those super cycle update cycles. Where they're not going to grow the iPhone sales 10% every single year, but they can potentially grow services at 10% every single year and kind of keep the company growing, because this company doesn't have to grow at a rapid clip in order to be a good investment, I don't think, at least, because they generate so much cash flow. They can buy back shares. Even if they don't really grow at all, they can still be a pretty good investment on that basis alone. It's just not going to generate 27% annualized return like they've had in the past couple of years, because a lot of that, if you think about that, yeah, they've grown their business, but they've also gotten reevaluated by the market. Right now, the market's pricing this at about a 3.5% free cash flow. When I was buying this stock in 2016, you were getting this at a 7 to 8 to 9 to 10% free cash flow yield. And that's a big difference from where it is today. So yeah, the company's grown. It's doubled its free cash flow in the last 5 to 7 years, or I guess 8 years since then. But the multiple has quadrupled basically. That's kind of the thing you're dealing with. Is the multiple going to revert? Right now, risk-free rates have really come down quite a bit, come up quite a bit rather. The expectations are that they're going to come down quite a bit, which is why the market's kind of keeping steady on some of these valuations. But if it takes longer for that risk-free rate to come down, if inflation rears its ugly head again, there's certainly some risk with the valuation aspects of some of these tech companies that are starting to slow down a little bit in their growth, and Apple is certainly in that area. If you look at their growth, they really grew really quickly during the pandemic. A lot of that growth was pushed forward, as it has been for a lot of these tech companies. But now they're slowing again. 2023, they're actually going to see shrinkage, or they already saw shrinkage. The expectations for 2024 are slight growth and then maybe speeding up again going into 25, although I think this is a bit optimistic. Again, I don't think the Apple Vision Pro is going to drive sales that much in the next couple of years. It's kind of going to be a small piece of the pie, potentially a lower margin piece of the pie as well, given the price and cost of that thing. Once they start releasing much cheaper versions, I'm talking about, maybe consumer appeal at $1,000 price point, $1,500 price point, kind of like the phone, but it's kind of a weird item. I don't know if it's that great. And then you've got services. What are they going to do with AI? What are they going to do with generative AI? How are they going to monetize that to the consumer? Because they're not really a business-oriented company. They don't sell a lot of their services to businesses. Some of their services and hardware is sold to businesses when you talk about phones and Macs, but in general, their services are more consumer-oriented. And can you get the consumer to pay $9.99 a month or $15 a month for AI features? If you can, then that's going to be amazing for Apple, who has this massive install base, a massive user base all around the world. The question is, how do they do that? When do they do that? And how does that impact their bottom line? And I think the answer is it's a couple of years away, at least. AI is still kind of in this initial iteration phase, and Apple's still certainly working on it. They might announce something in the next year or two, maybe even sooner, that says we've got this generative AI program called whatever. And I think that alone could be enough to boost the stock in the short term. But when we look at it from a long-term perspective, when I look at it from a long-term perspective, I'm kind of thinking 5 years out, when the actual hype of AI settles down, what happens to the company? And again, video, purely for informational purposes, it is not investment advice. Do your own due diligence. So as I look at this valuation, as I look at the stock that I own, a third of my portfolio in, so I clearly believe in it, what do I see? Well, it's a company that has really good margins, almost 30% margins, that has grown at a really solid clip in the last couple of years. That growth is slowing, that the market is valuing at about a 3.5% free cash flow yield. A company that buys back a ton of their shares every year. So that's kind of the way they return that $100 billion in free cash flow to the investor. They do have a slight dividend, but it's relatively tiny, but it's still about 15 billion given the number of shares that they have. So again, this is almost a $3 billion company, really good balance sheet, no real debt. They obviously have debt on the books, but it's supported by net cash on the books. And on top of that, they generate $100 billion in free cash flow every single year. And even during the pandemic, that didn't really slow down, right? So they didn't really take a hit. But again, the pandemic really benefited stay-at-home stuff. And buying a new phone is a good way to spend your stimulus money, because you're staying at home and you're using your phone all the time. So you might as well get a new super nice phone. And that's kind of why they were growing so fast during the pandemic, and why that growth has kind of slowed down. But if you think about a $400 billion a year revenue company, growth is just naturally going to slow down, because you have to sell so many extra phones. You have to sell so many extra Apple Vision Pros in order to get even 5% growth on something like that, because you're talking 3.5% growth here, and it's $13 billion in extra revenue. That is a large Fortune 500 company in its own, not to mention how this company is growing. So as I look at this company, I'm thinking growth is going to slow. I'm thinking 3 to 4% growth in the next couple of years, maybe picking up towards the latter part of this period as Apple Vision Pro matures, as they release and monetize some of their AI capabilities. Margins are going to improve for the same basis, right? They're going to get better on the services side because services are going to outgrow the hardware part of the business, and services is generally a larger margin business. And then the Vision Pro is going to actually be monetized at a better margin towards the latter part of this period, even as prices come down, because they can actually get better at designing it and getting the right costs on the parts that they use in there. Buyback is going to be a huge part of overall return. They're going to generate about $592 billion in free cash flow during this period. Dividends is going to be about 82 billion of that, assuming a 5% dividend growth rate. Maybe it's going to be higher, but in recent years, they've kind of slowed that down. Obviously not super focused on the dividend, meaning they have about 510 billion in excess cash flow. And most of that, 70% of that overall free cash flow is going to go towards buybacks. That kind of ties back to what they've been doing in the last couple of years. So buyback yield is a huge part of return. As you look at their free cash flow yield, the market's pricing them at 3.4% with a risk-free rate at 5%. Is that the right spot for them to be in? Maybe. I don't think that's too outrageous. Again, that risk-free rate is likely going to come down in the next couple of years. The market's pricing that in. If that changes, you could see a reversion to a higher free cash flow yield for some of these stocks. But when you talk about a company like Apple, a really pristine business that generates free cash flows regularly and is growing those free cash flows, albeit slowly, something like 3 to 4 to maybe at the low end of 5% free cash flow yield makes sense. Now remember, this was just a company that a couple of years ago was priced at 10% free cash flow yield. So things can obviously change. I don't think that's going to be the case anymore. I think the market was just wrong on Apple. That's why I was buying that stock hand over fist. I just wish I had more money at that point in my life. Now I have a lot more money than I did back then, but you can't win them all. Still is a huge returner for me and a huge part of my portfolio. So as I look at it this way, as I look at this sort of allocation, and I'll paste the spreadsheet in the description down below so you can kind of play around with whatever you want. 20% in the 5% free cash flow yield, 40 in 4 and 3 respectively. That kind of gives me a expected return of about 6.8%. You can kind of see the total returns here. They're not super attractive. There was a recent upgrade that kind of said a $225 price target on this stock. I could see that happening in the short term. If they announce something about AI, the market really loves that right now. Here's our new AI product. It's going to be amazing, etc. The stock price could really shoot up quickly. But from a long-term perspective, how can they actually monetize that? Do you think they can grow faster than this? If not, then this is kind of a realistic return for a company like this. And 7% obviously pales in comparison to the 27% they had in the last couple of years. Probably a bit lower than what I would expect from the S&P 500 in the next couple of years. And the reason for that is the market's really pricing this thing because it's Apple, right? It's saying this is the creme de la creme of companies. We're going to give it a free cash flow yield of X, and that X is probably the right number. Now, the upside from here could be, well, what if the market gives it a 2% free cash flow yield? Assuming some generative AI capabilities come out, or Apple Vision Pro is a huge, huge hit. Is that realistic? Sure, maybe. If that happens, obviously growth would be higher and free cash flow margin might be even higher, and they'd be able to do more buybacks. There's certainly some upside from this number. Now, the bear case would be, well, they're going to start slowing down in terms of their growth. This 3.5% is actually optimistic. The super cycle that people are expecting because phones are older isn't going to happen. Apple Vision Pro is going to be a dud. It's not really going to impact their bottom line too much. Generative AI is years away, and they're not going to be able to monetize it as well as some of these other companies that focus on businesses. Could the market reprice this to a lower yield? Potentially. And if you look at that, right, you're talking about returns that are possibly slightly negative. And this was a stock that was just $140 not too long ago. If we look at the price chart, go back to a year out, it was $135 a year ago. So why can't this stock be repriced back to $135, kind of a yield closer to, let's say, 5-6% like it was not too long ago? That's kind of the worry for me as someone who holds so many shares in Apple, and one of the reasons I'm thinking about selling a little bit of it, because the upside is uncertain, and the realistic assumption is that the return is going to be maybe in the high single digit. And the negative assumption would be that it'd be lower than that. And that's just not all that amazing. It doesn't feel like a stock that should go up 20% plus again in the next 10 years. That should go up even 10 to 15% up in the next 10 years, because at a 10% target return, I get a fair value of about $161. And maybe I'm being a bit conservative here with some of my assumptions, with some of my growth assumptions. You can be the judge of that. But for me, do I hate Apple as a company right now? No. I'm certainly not going to sell all of my shares, but I'm certainly strongly considering selling some of my shares, especially the ones that reside in a tax-free account and a tax-advantaged account, so like my 401k or whatever, because then I don't have to pay the massive taxes I would have to pay on my 600% gains. What would I do with the money? Because I'm going to approach my 20% cash limit. Probably just put it in the S&P 500, which already holds a bunch of Apple, so I'm kind of reducing my overall exposure to Apple, but I'm still having a bunch of it. Even if I sell 20, if I reduce my position to 25% or 20%, I still hold a ton of Apple, and I would still benefit from the fact that if I'm wrong, which I potentially am, I'd be fine with that, right? I still think that this company has a ton of potential. I think Apple Vision Pro could be really good in the long run. I think they do have the ability to be the best of breed when it comes to edge AI, when it comes to AI on your phone, because of the massive install base. I think there could certainly be an iPhone supercycle within the next 2 to 3 years because of how old these phones are. Is there anything else on the horizon that I see? Not sure, but I don't know if you need much more, right? This company is still going to generate 100+ billion in cash unless there is a recession. And if that's the case, maybe this company will fall back into a really attractive price point. Like what would be a really attractive price point for me would be anywhere in that like $130 to $160 range. That's kind of where I'd be a buyer, a big buyer of Apple. But at $190, am I a huge buyer? No. Am I a huge seller? Not really, but am I a slight seller? Yeah, probably. I just think that there might be better opportunities out there than Apple at this moment. But if you're holding a small to mid-sized position in Apple, if I was in that spot where Apple was, in that 20% range already, would I be selling? No. But because it's so much of my portfolio, I think I might want to sell a bit more. And like I said, this is a company that was already 40% of my portfolio before I sold some shares in December. So now that January comes along, it's just a continuation of that. It's just a continuation of the reevaluation of my portfolio. And speaking of my portfolio, there's a couple more moves I made. I list these out here. I closed my position in EA. I closed my position in Etsy, which I opened not too long ago. Closed my position in Snow, Texas Instruments, GWW, ESS, Tesla. Closed all of my positions there because I'm kind of working down my portfolio, whittling it down to something more manageable. I don't want to hold 40 companies within my overall portfolio. I want to bring it down to maybe 20 to 30 at most. That's kind of where it's more focused and drives better returns. So at the end of the day, am I going to sell Apple? I'm leaning towards yes, a little bit. But let me know what you think about Apple. Am I making a mistake here? Do you think this is still the best company to own, or are you better off in something different, even the S&P 500? For me, again, not a bad company, but a company that I have too much exposure in for how they're doing now, for how the market's pricing them, for what I expect to happen in the next couple of years. Because I'd much rather have 20 to 25% of my stock portfolio be in Apple than almost a third. And that's just the reality of stock investing. Sometimes you're over allocated to something, and once it's done really well for you, it's very difficult to let go of it because you feel like, well, this thing has quadrupled, quintupled when I've held it. It's obviously going to quintuple again. But even if it does, I'm still going to hold a bunch of it. And if it doesn't, I'm less exposed in my overall portfolio Apple's underperformance in relation to the rest of the market or in relation to the other stocks that may be out there. And maybe the idea for me would be, listen, I'm going to sell some Apple, but I'm going to put that money into the NASDAQ so I still have exposure to the tech market. Or I'm going to put it in the S&P 500 so I still have exposure to Apple and some of the larger companies that are doing really well right now and doing great things with AI and other stuff. So lots of thoughts to be had, but let me know what you think. Do you agree that Apple may be a little bit overvalued right now? Do you still think it has room to go? Would you be comfortable holding a third of your portfolio on Apple, or like me, would you think about selling? So let me know down below, like, comment, etc. Let me know if you want me to revisit any other companies or review any other companies. But otherwise, thanks for watching. Bye.